Friends, hello, it's Vicky with you again and welcome to my YouTube channel. Here I trade buying options on the PocketOption platform, and I want to remind you that in the description below this video you'll find a link to my private Telegram channel where you can find a lot of useful information and the most interesting analysis. So daily trading signals are published on Telegram channel, and if you text me personally, you will get a link to sign up for PocketOption with a gift deposit, 50% absolutely free as a nice bonus. So today I start trading with a deposit of $50. At the moment, I see that the price after a rapid fall began to pay off, and I will go into this movement. Since I see that the growth is not slowing down, I will go into the purchase at 100%. So, key macroeconomic indicators: unemployment, inflation, unemployment. The unemployed are people who lost or do not have a job, belong to the able-bodied population of the country. They want to find a job and are looking for it, and hard start working. Employed people are people who have a job, are employed, work part-time, work in government or military service, are self-employed, are absent from work due to illness, weekends, annual leave, maternity leave, or childcare, weekend strikes, and etc. What are types of unemployment? Frictional unemployment is related to finding a job, collecting information, and waiting for a job. It is usually voluntary and short-term in nature. Structural unemployment is caused by technological changes in the economy. It is forced and long-term in nature. So, frictional plus structural unemployment equals natural unemployment. The natural unemployment rate is the unemployment rate at full employment of resources, what is at potential gross domestic product or GDP. Cyclical unemployment reflects cyclical fluctuations and is characteristic of recession and depression. This is forced. The duration depends on the speed of the cycle phase change. So cyclical unemployment equals actual unemployment minus natural unemployment. And meanwhile, the deal brought me plus $89.5. So here is the moment for a U-turn. I go and sell at 100%. Unemployment expenses: decrease in actual total output, loss of GDP, reduction of economic potential, disqualification of a labor force, and etc. Financial costs, unemployment benefits, maintenance of employment services, and etc. Social problems: a decrease in income, an increase in poverty, a deterioration of the social and moral psychological atmosphere in society, an increase in crime, and etc. In the 60s of the 20th century, the American economist Arthur Oken deducted an empirical relationship between unemployment and GDP growth rate, which was called Oken's law. Oken's law assumes that a decrease in the GDP growth rate by X% leads to an increase in the employment rate by 1%. And the deal closed at plus $160.2. So I think that the price can still go down, and so I go and sell at 100%. So what are inflation? Inflation is an increase in the general level of prices for goods and services for a long time. Types of inflation: by rate of inflation, creeping. P is less than 5% per year. Moderate. P is more than 5% and less than 10% per year. Galloping. P is more than 10% per year and can reach from 30 to 50%. Hyperinflation, when the price level increases by an average of 50 or more per month. By the degree of openness, open inflation is expressed directly in price growth. Hidden or latent inflation is not manifested in the form of price shortage of goods. According to the degree of balance of price changes, balanced, all prices rise to the same extent, and unbalanced, prices for different groups of goods are growing unevenly. And meanwhile, the deal brought me a profit of $289.96. Great. But now you can turn around and I go into the purchase at 100%. By resources, reasons, factors of inflation. Demand inflation. With a constant excess of aggregate demand, other aggregate supply. A lot of money and few goods. The specific reason for the growth in demand is an increase in the money supply, money issue. Cost inflation, caused by an increase in the cost of production, which leads to a reduction in supply. Specific reasons: rising resource prices, higher wages, taxes, monopolism, high barriers in markets, and so on. By the degree of predictability of price growth. Unexpected inflation occurs spontaneously, unexpectedly, most often as a result of shocks. Expected inflation, on the other hand, price growth that can be predicted in advance. Types of inflation expectations. Static, expectation of the general price level or its changes in a future period at the level of the current period. Adaptive, formed on the basis of prevailing information about inflation in previous periods. Rational, it is formed on the basis of a broader information concerning the whole complex of factors affecting inflation. And meanwhile, the profit from the transaction is $524.83. So in the market, you need to be flexible. So I turn around and go and sell at 100%. The higher the inflation expectations, the higher the inflation. Effects of inflation. Redistribution of real incomes and welfare in favor of narrow strata of society in which incomes grow faster than the price level. On the contrary, for recipients with fixed income. The decline in the welfare of society due to a decrease in the purchasing power of money, especially for poor. The emergence of an inflationary tax on income recipients and buyers of goods. Decrease in business activity and results of the company's activities due to distortion of price signals, disorientation of behavior, difficulties of obtaining loans. Strengthening of short-term and speculative motives of economic entities' behavior. Violation of the price mechanism and its role in the market economy. Menu costs and worn-out shoe costs. So meanwhile, the deal closed at plus $928.95. Nice. So the price has dropped while I go into the purchase for all 100%. So the inflation rate is calculated by the formula PT, the inflation rate in the year T, and inflation rate in the reporting year, when PO is inflation in the base year. The Phillips curve. The Phillips curve is a curve illustrating the inverse relationship between the inflation rate and the unemployment rate. So P equals minus alpha multiplies the difference between U and UF. When alpha is the coefficient of sensitivity of inflation to changes in unemployment, and the difference between U and UF is the cyclical unemployment rate, the actual unemployment rate minus the natural unemployment rate. The Phillips curve is backed by expectations. P equals minus alpha multiplies the difference U and UF plus P plus epsilon. So where PE, the level of expected inflation, epsilon is a parameter reflecting the effect of price shocks on inflation, alpha is the coefficient of sensitivity of inflation to changes in unemployment. And meanwhile, the deal brought me plus $1,625.66. So nice. So for today, I'm finishing with overlooking a deposit of $1,625.66, and I started only with 50. So I thank you for watching this video till the end. I hope you like it. I hope you write your comments down below and you make sure to subscribe to my channel, because there's always only useful information and the most interesting analysis. And I wish you only successful trading in your future trading sessions. And that's all for today. See you in the next video. Bye.